Hi, I'm James Robinson, and this is my stock pick of the week. This week's pick is MSC Industrial Supply Company. MSC Industrial Direct, or MSC Industrial Supply Company, is a leading North American distributor of metalworking and maintenance, repair, and operating products and services. So one of the things that happens when I'm researching a company is I'll often stumble across other companies that are in similar industries or that do similar tasks. So a week or two ago, I did a report on Snap-on. And Snap-on obviously is a company that provides tools to industrial users. And MSC is a company that came on my radar as a result of that research. They do the same kind of thing as Snap-on, although they don't produce their own things, they sell for other people. But they do goods and services for a wide range of companies, from individual machine shops to Fortune 500 companies. They help the GSA as well as the Department of Defense. Basically, any industrial operation will have a need for MSC and their products in one form or another. Just to give you a sense of how big this company is, it has 1,650,000 SKUs, and a SKU is an inventory item or a category of inventory. So they carry a fantastically wide variety of articles that they keep in their inventory. And almost all of those products can be delivered in the same day through one of the firm's 12 regional headquarters and 99 branch offices. The company has offices across America, Canada, and the UK. The company has 6,500 employees and is based in Melville, New York, and was founded in 1941. The company's market cap is $3.71 billion. It has revenues of $3.3 billion, profits of $296 million. Its PE ratio is currently 12.72. It pays a nice yield of 4.41%, and the company has $530 million in debt. Here you can see the company's ratings in the various categories that I look at. Again, I look at 29 categories. I grade those categories on a score of 1 to 4, 4 being the best. There are 9 operating categories. That's how well a company delivers goods and services. There are 10 financial categories. That's how well the company handles risk and especially debt. And there are 10 management categories, and that's a measurement of how well the company returns wealth to the shareholders. The one real red flag for this company, and something that bothers me quite a bit actually, is its 10-year return on retained earnings. The company's profits have been relatively flat for 5 years. And so those retained earnings that it's kept haven't really been able to create much value for shareholders. The company has managed to increase its profits per share because it's bought back stock, but the profits have been relatively flat. So that's something that we would keep an eye on as if we were long-term owners of this company. Having said that, it is of the 833 companies that we've investigated, its rank is 131st, so it's a very solid company. Anytime a company has a total GPA of greater than 3, it's something I'm interested in buying if the price is low enough. And this company's trading at 12.5 times earnings is a good deal economically. It pays a very nice dividend. I think there's some upside, more upside than downside. Plus, the company does have some competitive advantages in its industry. The one thing we always look at, the first thing we look at are gross margins. Here you can see the gross margins are above what I consider the desirable level. They have been pretty constantly since 1999 and before that. So that's all I need to know. That tells me this company has some pricing power. It has some ability to withstand bad times if they should occur and still remain profitable. So gross margins of this company are more than adequate. So here you can see the earnings per share, and you can see that between 2012 and 2017, they actually had been going down. They made a nice jump this year, and again, if you look at it, there's a pretty good trend line from about 2002 through 2018. A couple of hiccups along the way, but that's going to happen occasionally, especially with an industrial company. The problem with an industrial company is they need other companies to be doing well in order for them to do well. But it looks like things are moving up, and we think that the chances are that this company will continue to produce better and better profits. They'll buy back shares, and while we wait, we'll make a nice 4.5% dividend, so it's better than leaving our money in the bank. Net earnings as a percentage of revenue have been very constant. This is a good measure of how well the company is doing in terms of converting dollars that come in the door into profits on the bottom line, and we like to see that be very, very stable. We don't like to see gyrations there, and this company, I think you can recognize, is doing just that. Selling and general administrative for this company is very high, almost disqualifyingly so. However, you have to recognize that with 100 offices and all these warehouses, they're going to have a lot of inventory and they're going to have a lot of selling expense because they're a distributor, right? They don't manufacture very much, so really their cost is going to be the cost of inventory and the cost to get out and sell that stuff. So it's high, it's higher than I'd like, but it's really the only real red flag that in inventories that are here in the four taxes. And some companies have issues with research and development, and other companies have plants and equipment. These guys have high selling and general administrative. Plants and equipment is kind of nominal. It's not in the top 25%, but it's kind of slightly better than average. And when we figure this company's basically a warehouser of parts, you would expect that it would have a lot of real estate. So here you can see that inventory cost. Two things to keep in mind here. It is very high. It's amongst the highest I've seen, but again, they have 1.6 million SKUs they've got to keep in check. But the other thing is it's gone down very considerably. It's almost cut in half inventories to revenues since 1999. This company continues to seem to be trying to find ways to get their inventory down. And while I'm not sure it's ever going to be a strong point for this company, if they can continue to create benefits and lower those inventory costs, that's a benefit that'll accrue directly to us. Research and development that has no cost there, which is one of the things that offsets the higher inventory and higher SG&A costs. So the first thing that's going to pop out at you when you look at interest expense is that it's gone up pretty dramatically since 2008. But it has gone up dramatically in absolute terms. It's gone from nothing to about 15 million. But in terms of interest expense as a percentage of operating revenue, it's a non-issue. We don't like to see companies over about 15% of its interest expense being about greater than 15% of operating income, but these guys are less than 5%. They're actually less than 4%. So they've taken on some debt, but it's nothing that the company can't handle. It's nothing that's really impacting profits. And so I'm fine with it. So I've started showing this slide because some companies are paying off some debt, but creating debt, but they're doing that to offset the fact that they have money that was offshore. For example, Apple, that they didn't want to pay taxes to bring back. And so I've started showing you what the net interest income is and comparing that to interest expense. In this case, it's really not very significant, the interest income, so there's not much to talk about here. So debt analysis, you can see the long-term debt has gone up since 2012. However, it really hasn't gone up very much. It's been relatively flat from 2012 to 2018, and so it's not a big deal. Also, very surprisingly, current liabilities, which had been going up at a pretty consistent rate from 2012 to 2017, seem to have dropped in 2018. That's a good trend. That might be one of the reasons the company's been able to make some money, and we'd like to keep an eye on that and see if that trend can continue and they can be more efficient with their current liabilities. Another thing that we like to do when we look at debt and try and have a sense of how big the debt, how large a risk debt represents to the company, is to try and figure out how many years would it take to pay off our debt if that was the goal of the company. And I'd like to see the company be able to do that in about 4 years. This company can do it in just under 2 years. So the debt that they carry is kind of not very important relative to the company's long-term safety. Another measure of the safety of the debt is to look at the interest coverage ratio. That's how much money the company has in income relative to its debt costs. And when you look at this chart, you got to look kind of closely at it. You can see that at one time it had 1,800 times as much money as it needs to make its interest payments, and that number has dropped down dramatically. But we look at anything over 3 or 4 times is safe, and this company is far, far ahead of that. You can look at the lowest line there is 450 times. So interest coverage ratio is not an issue for these guys, even though they have $500 million in debt. I'm not sure what I think about cash equivalents, and marketable securities. That number has gone down since 2008, almost every year, not quite in a straight line, but has gone down. And I think it's pretty low now. I mean, it's at $40 million of cash. I don't think that's enough money for this company. I would like to see this company start to stockpile a little more cash for a rainy day. I recognize the company's making sales and it's using its sales to fund its operations, and it does have a decent ratio of current liabilities to current assets. But I would just prefer to see this company have a little more cash on hand due to its debt load, and it's not enough, in my opinion, for a company this size. But having said that, here are the current assets to current liabilities, and let me explain to you what's going on here. Current assets is money that the company either currently has or expects to have in the next year. And current liabilities is the same thing. It's expenses the company will incur in the next year. And so in this measurement, the company is in fantastic condition. they've got enough money in current assets to far more than pay its current cost. And so that's why they're comfortable not having enough money, what I think is enough money in cash and marketable securities. The problem with this is if an economy gets a downturn and a few of their big products, big companies start to have trouble making payments, that can very quickly impact this company's ability to meet its current liabilities. And so while I recognize they have plenty of money coming in theory, to pay all their bills, I'd like to have them have a bigger buffer in terms of cash. Shares outstanding, you see the company has gone from about 70 million shares outstanding down to about 55 million shares outstanding. They bought back shares each of the last 5 years. It looks like they will continue to do that. That's one of the things that's made the company more attractive to me, because while its income has been relatively stable the last few years, with the exception of last year, they were continuing to buy back shares, continuing to pay dividends, which meant I was getting my money back and getting a little larger share of the profits every year. And so that's a trend that makes me feel very comfortable. So I try and do this every time. If you had bought 10% of MSC stock at the end of 2008, you would have owned about 6.3 million shares. Today, because of stock repurchase, the 6.3 million shares would mean your ownership has gone from about 10% of the company to 11.3% of the company. So you have about 13% more of the company than you did 10 years ago. During that time, a share of the company's earnings, your share of the company's earnings would have been worth $12.5 million in 2008 or 2009. Today they're worth about $37 million. So while the income has been flat the last 5 or 6 years, in general over the last 10 years they've tripled their income and given you a larger portion of the profits. So long term, this company seems to do well. Here you can see dividends paid out, and there's a couple of unique dividends that show up here as a big payment, but generally speaking, the dividends per share have gone up pretty dramatically since 2003. So this company's does a great job of not only paying me a dividend, but increasing my dividend year in and year out. Having said that a company pays a good dividend, that of course doesn't tell us everything we want to know. We want to know how sustainable is that dividend payment. So we look at dividends in terms of yield and growth, dividend safety in the context of earnings, dividend safety in the context of cash flow, and dividend safety in the context of the company's current debt load. So yield and growth, the first thing that we look at here is the company pays a yield of 4.41%. That's excellent. The average for the S&P 500 is 1.92%, so it's twice what the S&P 500 pays. Also, the average dividend growth for the last 5 years has been 52%. Now, that's a little bit of a misnomer because they paid a one-time large bonus dividend in 2015, so that kind of skews the numbers. But again, generally speaking, the dividends have been growing and been growing nicely, and ignoring that aberration, the company's still done pretty well in terms of growing the dividends. The next thing we look at is current payout ratio. What percentage of the profits that the company makes are they paying in dividends? We don't like to see that get too high. The S&P 500 is around 40%, so we don't want to see it get too far from that. The current payout ratio for this company is 38.4%, so it's in the right range. The average payout ratio for the last 5 years has been 57%. But again, that's because in 2015 they paid that special dividend where they actually paid out more in dividends than they made in earnings. You can see in 2018, because the earnings jumped up significantly, the payout ratio was less. So it's going to bounce around a little bit. But in general, the company, again, seems to be doing a good job. So dividend safety in the context of free cash flow. So the dividend payment of free cash flow is about 42.6%. Again, that's very safe. The average for the last 5 years is 62%. Again, we had that aberration in 2015. But let's just walk through what this really means. So the company had cash flow from operating activities of about $339 million in 2018. They had capital expenditures of about $44 million. So that meant they had free cash flow of about $295 million. They paid dividends of about $125 million, and that's where you get the 42%. And you can see that again in 2015 they paid 143% of their cash flow out in dividends, and that was just sort of a one-time thing. We could get into why they did that, but it's really not relevant for what's going on with the company in the long run. So the final thing we look at in terms of dividends is dividend safety in the context of the company's current debt load. So what we're really trying to figure out here is if interest rates were to go up, which I think is inevitable in the long term, how will that affect the company's ability to pay its obligations, its debt, and still maintain the ability to pay the dividend? And so we can, with short circuit, this company doesn't have very much debt. But if interest rates were to go to 27%, that would mean they'd have to pay another $47 million in interest over and above what they're paying today. The new adjusted cash flow would be $246 million. They'd still have to pay dividends of $125 million. So free cash flow minus dividends would be 121%. So the company, if interest rates went to 20%, the company would still only be using 50% of its net cash flow to pay dividends. So we're very comfortable that the debt load for this company is not a problem in any way. Here you can see shareholders' equity. It's managed to go up until about 2013 when it started to slow down and actually went down. Company had a couple years where it didn't make money. It was paying out a lot of dividends. Again, in 2015, it dropped because they paid that big dividend, one-time dividend, and they've been buying back shares. So I suspect that trend will start to go back up again, hopefully over the next few years. That's what I'm betting on as I'm buying the company. So I mentioned I had some concerns about the company's ability to generate profits from retained earnings. And that's a legitimate concern that I continue to have. But this is the slide that allows me to overlook it and allows me to say it's probably okay. This is company's return on assets. So the company needs a certain amount of assets to run their operations, and how much money they make in me as a shareholder as a result of that. And that number has never been outside of the top 10. Well, it was back in the early 90s, but since the early 90s when they got their inventory under control, it's never been outside the top 10. This is really impressive to me, and this is the reason I really like this company. Return on shareholders' equity is exactly the same thing as return on assets. However, it does take into account the fact that the company is using some of the bank's money to run its operations and not some of my money. So what you'll see here is that companies that have a tremendous amount of leverage and hoard a bunch of money tend to perform better on return on shareholders' equity because there's just very little shareholders' equity to worry about. A company like ours that has tremendous amount of equity and very little debt has a hard time competing with those companies for that reason. So the fact that this company's in the top 25% pretty consistently, even though they don't have much debt, I've talked about this before, is a really strong sign that this company is very well run and using its assets frugally. The first question I like to ask about a company is, does it have a consumer monopoly? And it doesn't have a consumer monopoly in the purest sense because it doesn't sell to consumers, right? The company does have a durable competitive advantage in its market. And the durable competitive advantage the company has is that it's so large and it's nationwide. And therefore, it's a natural fit for Fortune 500 companies and government companies that just want to have one client or one customer, one provider around the country that services all of their facilities without having to get a different guy in every market. And so because this company is so large and because they carry such a large inventory and because they've mastered the ability to be able to deliver those products in a speedy and timely way, that's their competitive advantage, and I think it's significant. The company's solid financially. It does have $530 million in debt, but this represents less than 20 months income, so they could pay it off if they had to. The company does a pretty good job of rewarding its shareholders, pays a 4.41% yield. It's bought back 13% of the company in the last 10 years, so reasonably good in that category. Although again, we don't love what the company has been doing with retained earnings, but I'm willing to overlook that because of the company's strong return on assets. The company's earnings have been flat for the last several years, which has hurt the stock price. However, they did increase earnings last year, and between the high dividend, the low PE, and stock repurchase, I believe that even flat earnings will pay a reasonable return on investment over time, and I think the company will turn it around and create some additional profits. So yes, I would buy the stock. It's currently priced at $67.99, and so I think you should go ahead and buy it. So a few weeks ago, I guess last week, I went over my quarterly reports. Since I did that, I bought Altria Group and I bought Apple stock. I did that because Trump announced he was going to put some tariffs on companies, and Altria dropped down below where I initially bought it back in February. And I love Altria. I think it's a great company, and so I thought that was just a chance to buy it on a dip. The same thing happened with Apple. If you remember, I sold it on July 31st at $220 a share. I bought it back on 8/5, so 6 days later at $195 a share. And so I'm comfortable with that. And then obviously you can see that I added MSM. I'm not going to talk too much about my results. The market's really sort of gyrating right now because of the trade deal with China. We are continuing to outperform the market, and but we've added 3 new positions, and I'm pretty comfortable with where we are right now. By the way, I do have a number of stocks that are down, and down significantly. I'm not worried about that. I think that these companies will turn around. I like our dividends in most cases. I continue to like the companies in most cases, in all cases. And so, sometimes you just have to be patient. These things don't turn around. We've had some really good luck with Altria and H&R Block and Phillips 66, but to some extent that's really been luck. It hasn't been skill that, Robert Half would get a 15% return in less than a month. That's just been fortuitous timing. What we want to look at is over the course of a year and a half, we're able to get these companies to turn around. And I haven't owned anything for less than for even 7 months yet. So there's just no reason to be concerned about the fact that some of these stocks are down. In fact, they might be for some of you buying opportunities because, for example, Waddell & Reed, I thought it was a buying opportunity back at 1877, and today it's at 1650. So that's a pretty significant drop, and the company plays a decent dividend, it's a solid company. So, if you think I've got any idea what I'm doing, then, go and buy some of these companies. Anyways, that's it. That's the stock pick of the week. Thank you very much for your time.